Hi, I'm Jimmy. In this video, we're looking at the fact that the S&P 500, the stock market, has been down recently and probably should be down. So far, it's down about 7.5%. This is a chart from the start of the year, the end of last year, the 31st of last year, up through yesterday, and the stock market so far is down about 7.5%. And it looks like it should keep falling further. And this is because of the way stocks are valued. So here's what I mean. When we click over to here, this is a fair value calculation for Microsoft stock. And we can see that this box right here is showing that we have a fair value of $228 per share. Right now, Microsoft's trading at about $295 per share. So it looks like the stock could be a bit overvalued according to this valuation method. But here's the most important part, and it doesn't really matter whether or not we believe in this valuation method, because almost all valuation methods are going to be tied to this concept. So first of all, this is a website that we're building. This spreadsheet right here is a website we're building. You punch in the ticker up here, it takes analyst estimates and automatically calculates the fair value using whatever required rate of return we decide to be important. I'm using 7.5%, and that is because it is currently it's about a 5% premium over AAA corporate bonds. So we're going to come back to this in a second. But, so if you want to sign up for that website, the website will be up in a couple months. I will leave a link in the description below for how to sign up to that website. Okay, but now here's the important part. The 7.5% and even the company's weighted average cost of capital, it doesn't really matter what required rate of return we use. If you use 10% or 12.5%, it doesn't matter. It's going to be somewhat tied to, it should be tied to what interest rates are doing. 7.5% makes sense for me when interest rates are down near zero. But if interest rates were 12%, well, frankly, none of these required rate of return would make any sense. So here's the important point. What if we were to increase, for me, I'm using 7.5%. What if we were to increase the required rate of return from 7.5%? Well, the 228 that you see on the screen, when I change that to 8.5%, drops to 191. So right now, we're saying that Microsoft at 7.5% was worth 228, but because we had a 1% increase in the required rate of return, well, now the fair value drops to 191. So the fair value fell a decent amount. Okay, what about a different stock? What if we were to look at a stock like Home Depot? So we go back to our 7.5%. We'll see what that's worth. Home Depot, we punch in the ticker. We get a fair value of 286. Okay, simple enough. But now we switch over to 8.5%. 286 falls to 232. Okay, what about Lowe's? Okay, Lowe's, we punch in the ticker. At 7.5%, we get a fair value of 218 per share. And then when we switch over to 8.5%, we get a fair value of 176. Now, here's the important point. I did this for all 30 companies in the Dow Jones Industrial Average because I was curious, on average, how much do stocks drop? What does the fair value drop when a 1% increase in interest rates happens? On average, for the stocks that it worked in the 30 stocks in the Dow Jones Industrial Average. Discounted cash flow doesn't really work for financial companies, insurance companies. So Goldman Sachs, JP Morgan, and Travelers Insurance, that didn't work there. Something better there would be something like price to tangible book value. Would be much better valuation method to use. But using the other 27 companies in the Dow, well, the average drop was 19%. Now, we already saw that the stock market is dropping about 7.5% over year to date, but we can see that with an average drop of about 19%, it is possible that there's still room to fall. It is possible that stocks must continue to drop. Now, the reason why I'm saying that is that the Federal Reserve is expecting, many investors, especially economists, are expecting for the Federal Reserve to start increasing interest rates to help combat inflation. That's the real problem with inflation, outside of all of our goods and services cost more money. But still, the Federal Reserve's reaction to that is going to be to increase interest rates. If they increase interest rates, now let's say they do it by 0.5%. Well, fine, maybe it doesn't fall by 18 or 19%. Maybe it falls by less than that. But I don't think 7.5% is quite there yet. More importantly, because we can see that an increase in our required rate of return whatever it is. You might have noticed that these increased as well. If you had 12.5% and they increased interest rates by 1%, well, it's logical that you would go to 13.5%. If you were at 10, you go to 11. If you're at 7.5, for me, you go to 8.5. So I think the important point here is that now we identify stocks. If we think that the Federal Reserve is going to increase interest rates, let's say 1% over the next year, it might make sense to get ready to increase our required rate of return. We don't necessarily have to do it right now. I'll probably do mine once they start increasing interest rates, because they're not going to increase it 1% as soon as they increase it. It'll probably be a quarter of 1%, maybe a quarter of 1% 4 times over the next year. Maybe it's a half of 1% and then a quarter and a quarter. We're not quite sure how they're going to do it, but it's a near certainty that they're going to increase it. So it might make sense to, if we're at 7.5 and they increase it a quarter or they increase it a half, increase ours by the same amount. Now, an alternative method is to use the company's weighted average cost of capital. So the company's weighted average cost of capital varies from company to company based on a whole bunch of different factors. Again, I did a video, link in the description below, for how to see what cost of capital is. I find it's a safe bet. If you're not sure what required rate of return to use, just use the company's weighted average cost of capital. It tends to be fairly safe, but it also factors in interest rates. Now, it usually factors in like a 30-year bond or 10-year bond. So a lot of those, they move around a bit more. So you might see some volatility from day to day. But still, if you invest in stocks that are looked to be well priced, if we're looking for value stocks, we find value stocks that are well priced at, for me, I'm using 7.5%, so I'm using 7.5%. I'm also taking a peek at a lot of these stocks now at 8.5%, assuming that they increase interest rates over the next year. And is it good for the company's cost of capital? So I want the weighted average cost of capital, I want it to look reasonably priced there. That being said, I actually found 3 dividend stocks that look like they could be reasonably priced, and I want to do a deeper dive on these. Each of these 3 stocks came out of our investing community. The first one is BWA, which is BorgWarner. What they do is they make engineered systems and components, I believe they describe it for the powertrain systems in automotive. So basically make car parts. But we can see that at 8.5%, which assumes a 1% increase by the Federal Reserve over the next year, well, the stock looks like it could be undervalued right now. Using their cost of capital, they have a reasonable cost of capital of 8.7%. Still undervalued. Now, we still have to do a deeper dive to see if this company is in fact worth it, but they pay about a 1.5% dividend yield. So overall, I think this is one company to consider. Okay, the next company is HanesBrands. HBI is a ticker symbol. And this is, they make socks, underwear, t-shirts. They have, Hanes, the brand Hanes. And basically, at 8.5%, they should be worth $17. So we got some upside there. At 7.4%, which they have a fairly low cost of capital, which would make sense for a more defensive type of company like this, they've got a fair value of $24 per share, and they pay an almost 4% dividend yield. This one looks super interesting to me. This is a company that I think we should do a deeper dive on, because if we're worried about what happens when they increase interest rates, we're worried about the stock market continuing to fall, I want to buy stocks at a good discount, even if they do increase interest rates to offset inflation. And it looks like HanesBrands could be a good one. Okay, next we have a company that came out of the community. This is a smaller company, and this one's called Sanderson Farms. We can see at 8.5%, it's worth $199. The stock's currently trading at $181. They have a very low cost of capital at 6.5%. Again, this is a defensive type of company, so it would make sense that they would have a lower cost of capital. But again, this looks reasonably priced at both 8.5%. That's assuming a 1% increase. So we're really jumping the gun. I don't think we need to increase our interest rates, our required rate of return, that dramatically at this point. I just wanted to illustrate that when you change from 7.5%, or if you change from 10% to 11%, there's a natural pullback in the value of stocks, just like stocks should have skyrocketed. Maybe not skyrocketed, that might have been over an exaggeration, but just like stocks should have gone up when they decreased interest rates, we have to expect at least some of the opposite effect when they increase them. So this makes buying stocks so important. Buying stocks at the right price so important. That being said, if you are interested in getting access to this calculator, again, the website will be up in the next couple months. By the end of the second quarter is what we've been telling everybody, and that's what we're aiming for, hopefully sooner, but that's sort of the target. So if you're interested in signing up, I will leave a link in the description below. In the meantime, you get access to our investing community. We do 3 live streams per week where we pull up this calculator. We try to come up with the fair value for a bunch of companies that you guys throw at us. And yeah, I'll leave a link in the description below as to how to sign up. Thank you so much. I will see you in the next video.